Hi there and welcome back. In this video, we're going to walk through the first of a number of different tax minimization strategies, and we're going to look at them through three different lenses. So the first is that we're going to look at it at the effect on your profit and loss statement, essentially the effect of your tax position at the end of financial year. Second, we're going to look at it through the lens of what's the effect of this decision on your business value. And finally, we're going to have basically summarize the net effect of planning for tax versus planning for business value maximization. So let's jump into it. So the first of our tax minimization strategies we'll do is reducing assessable income, or essentially deferring invoices from this financial year into the next financial year. So what we're going to do is we're going to look at the profit and loss first, and I'm going to assume that you've seen a number of profit and loss statements before, so I'm not going to go through all the details here. But suffice to say that we've got a hypothetical business here. It's on track to be earning 1.25 mil in revenue in this current financial year, and with a number of these COGS and profits and overheads, basically it leaves this business with a net profit or a high level EBITDA of just over 412k, with a corporate tax rate of 25%. This company is on track for a 103k tax bill to the ATO, and it looks like it's going to be booking profits of around 309k. Now, let's look at the same business, and instead of booking the entire revenue, let's say that we're approaching the end of financial year. Let's say that we're in the month of June, and we make a decision under advisement that rather than writing all of our invoices this month in June, why don't we just push some of them a few days out so that they actually land, are written in the next financial year in July. And so it might not even be 30 days, depending on whereabouts in June you sit. And so that might mean that we might reduce our revenue, our invoiceable revenue this financial year from 1.25 mil to 1.15 mil. Now, why would we want to do that? Well, essentially, if you follow the numbers down, it basically means that you end up with a tax bill of just under 87,000K in this case, which is a big difference from 103K. So essentially, for deferring your invoices a few days, it basically means that you save $16,250 on tax that you now no longer have to pay the ATO. So it seems like a big win for not a lot of effort. Now, let's have a look at the effect of this on your business value. Now, we're going to use a very conservative earnings multiplier of 2.5. It's not uncommon to have multipliers higher than that based on the strength of your business, but let's just be conservative here and use 2.5. You also may recall that the earnings multiplier is multiplied against your EBITDA to arrive at your business value. So if you left your current financials as they were, your EBITDA would be 412K with an earnings multiplier of 2.5, gives you a business value of just over $1 million, which is a nice tidy sum for a business owner to walk away with. Now, let's say this same business owner made this decision to defer 100K of their invoices from this financial year into the next financial year. But then let's say a business valuation event got triggered. What would the business value be? Well, if we look at the EBITDA of this business, it's now only 347K multiplied by 2.5 means that your business value is now worth less than 870K. Or if we look at it here, a big difference of 162,500. So essentially, for the sake of saving $16,250 on tax, you've actually cost yourself $162,500 on the value of your business. Now, if that sounds bad, it actually gets a bit worse than that. So if you were paying attention before, you may also have realized that if you just kept your books as they were, you would have actually been booking 65,000K of net profit with your current financials. So let's factor that in as well. So let's say you kept your current financials as they were. So here you're actually preserving the 65K of profit. So you're preserving that. You're foregoing the $16,250 here. And so your net post-tax profit is actually you're still better off, $48,750. And on top of that, you've got an increased business value of $162,500, as we pointed out earlier. So essentially, if you kept your financials as they were, basically concentrated on your business value rather than trying to pay less tax, you would have been $211,250 better off. But if your focus was just to pay tax, you would have only been better off $16,250 and still at the cost of foregoing $162,500. So really, very, very big difference for a very, very common tax minimization strategy, and this is just one. So we've just isolated just this one tax minimization strategy. Let's wrap up this video here, and let's move on to the next strategy in the next video. I'll catch you over there. Bye for now.